In this video, we're going to be performing a deep dive on Genuine Parts Company's dividend safety. To begin, let's talk about Genuine Parts' business model. Genuine Parts Company is an automotive parts retailer. The company was founded in 1928, and since that time, it has grown into a sprawling conglomerate that sells automotive and industrial parts, electric materials, and general business products. Its global span reaches throughout North America, Australia, New Zealand, and Europe, and is comprised of more than 3,100 locations. Genuine Parts has nearly 50,000 employees and trades with a market capitalization just under $15 billion, with almost $19 billion in annual revenue. Genuine Parts Company is a well-known dividend stock because of its compelling track record of dividend growth. With 62 years of consecutive dividend increases, Genuine Parts Company is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. In fact, Genuine Parts Company's dividend history satisfies the requirement to be a dividend aristocrat more than twice over. With more than 5 decades of consecutive dividend increases, Genuine Parts Company is a member of the Dividend Kings, a group of even more exclusive stocks with 50-plus years of dividend increases. Looking ahead, Genuine Parts Company's high dividend yield has led some investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Genuine Parts Company's dividend safety in the context of the company's current earnings. When Genuine Parts Company announced its third quarter financial results on October 18th, the company reported that it generated earnings per share of $4.23 through the first 9 months of the fiscal year. For context, Genuine Parts Company paid $2.16 of common share dividends during the same time period, for a dividend payout ratio of 51%. Using earnings, Genuine Parts Company's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare Genuine Parts Company's current dividend payment to its free cash flow. Through the first 9 months of fiscal 2018, Genuine Parts Company generated $926 million of cash from operating activities and spent $92 million on capital expenditures for free cash flow of $834 million. The company distributed $310 million of common share dividends during the same time period for a free cash flow dividend payout ratio of 37%. Using free cash flow, our conclusion is the same as when we use earnings to measure Genuine Parts Company's dividend safety. The company's dividend appears very safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Genuine Parts Company's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Genuine Parts Company's performance during this time period is shown here. Genuine Parts Company's earnings per share declined by 16% peak to trough during the last recession. More importantly, the company's earnings continued to cover its dividend, and it continued its multi-decade streak of consecutive dividend increases. With that in mind, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Genuine Parts Company's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. Through the first 9 months of fiscal 2018, Genuine Parts Company generated $76 million of interest expense and had $2.9 billion of debt outstanding for a weighted average interest rate of 3.5%. The following image shows how changes to Genuine Parts Company's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Genuine Parts Company's weighted average interest rate would need to rise to well above the 20% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that Genuine Parts Company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Genuine Parts Company's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Share Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.